Let's get started. So my name is Mark Lamonica. I'm the product manager for Morningstar Premium and morningstar.com.au. Today, we are going to talk about value versus growth. So anyone who's been paying attention over the past 3 months should know that maybe this will be an interesting topic, but we'll get into why that is. But first, our housekeeping items. The thing you hear today is general advice. I can't offer you any personal advice because I don't know anything about you. Other things for our friends in New Zealand. Let's see if I can remember all this. One, you can go to our website to find the FAP statement. So that's morningstar.com.au. If you're interested in personal advice, you should go consult a financial advisor. I think that's everything. We'll just go with that. All right, so we'll get started. All right. Julie from Sydney is back. Thank you for that. I would like questions. So questions or comments. Tell me where you are and what's going on. All right, I will share my screen. So we're going to talk about value versus growth. And as I said, there's been some really interesting things that have happened in the market over the past 3 months, which we will get into. But first, let's give a little bit of a background. So those two, I won't make any statements. Those two are Fama and French. So Eugene Fama, he's a Nobel laureate, which is good, which is why I should not be making fun of the clothes that he's wearing. I also think it's a photo from the 80s and everyone dressed that way. Maybe, I don't know. They are both former professors at the University of Chicago Booth School of Business. And they did a very famous study called the three-factor model. And so what they did is, you can see outlined on my beautiful slide, they looked at 3 different factors. They looked at the size of firms, they looked at book to market value, and we'll get into what that means in a second. And then they looked at returns, and they went through and they tried to figure out, is there any correlation between these 3 items? And obviously what we're interested in as investors is return. So let's go through each one of these. Size of firm. So size of firm, when we're looking at the size of firm, we mean the market capitalization of a firm. So that is the amount of shares outstanding multiplied by the stock price. Tell if we tell a firm is big or small. Second one, book to market values. So basically what they're doing is they're looking at book value as a proxy for value versus growth. And we'll get into some of the other things that you can look at. But basically book value at the end of the day, a simplistic definition, is we are looking at the balance sheet of a firm. So we're looking at the net assets minus the net liabilities. Or sorry, total assets minus the total liabilities. That's what we're looking at, is book value. And book value, of course, is something that probably had a lot more importance back when firms had more tangible assets, things that were sitting on the balance sheet. But regardless, it's a proxy for value versus growth. And when we're talking about value versus growth, before we get into the outcome of the three-factor model, what we're basically doing is we are taking the universe of securities that are out there. So there's 2 different things we can do. We'll talk about style in a second, but we're taking the universe of securities, and we're basically dividing them into these buckets. And they don't all have to go in each one of these buckets. We also have this notion of core, which sort of things in the middle. And what we're trying to determine is, we're basically trying to divide them up by valuation measures. So that could be book versus price or market value, book versus price. It could be price to earnings, it could be price to cash flow. There's all sorts of different valuation measures we can use. And so we divide up the universe of securities between value versus growth. Now, very important thing to remember is, just because a company is a value company one day doesn't mean it needs to stay there. You can move around. Companies can move as these valuation metrics that we're looking at, as they change, a company could move. So it's not like you're forever locked as a value company or a growth company, but we'll get into some generalizations later. But anyway, they looked at these 3 different factors and they discovered that smaller firms and value firms perform better. And they looked obviously at very, very long set of data, and that's what they came up with. So if we're looking at factors, we want things that outperform over the long term. We're looking at smaller firms, and we're looking at firms that are value shares. Now, as a little preview, and we'll get into this in a second, the exact opposite has happened since the GFC. Large cap, large firms, growth firms have significantly outperformed, but we might be at an inflection point. So that's what we're going to talk about today. All right. And this, by the way, this is the Morningstar, and don't look at the numbers, which means I probably shouldn't have put them on there. You know when people say that, don't look at the numbers when you put them on there? Anyway, that's just a portfolio I took a snapshot of. So this is the Morningstar style box, where basically if you put stuff into our portfolio manager, it'll classify things in value versus growth and large cap versus small cap, so you can see where you're sitting. And of course, blend is things in the middle. All right, so to look at performance, we're going to use, and these are two US ETFs because I could not find similar ETFs in Australia. We're going to use two ETFs. So both of these ETFs are, I believe, iShares ETFs. So that is BlackRock. But here we go. You can buy an S&P 500, so 500 biggest firms in the US. Value ETF, you can buy an S&P 500. Growth ETF, and you can see right here how they actually, or the description of these two ETFs. You can also see, because hopefully everyone on here is smart enough to do some math, that there's overlap, right? So there's 436 holdings in this value ETF. There's 233 holdings in this growth ETF. So that's based, of course, on what they are looking at, the criteria they're looking at to put things in here. And you can see we've got a couple stats in here, and these stats are a couple months old at this point. But price to book value, remember that's what we were talking about before, 2.46 for this value and over 10 for this growth ETF. P ratio of just under 21 for this value and over 40, just under 41 for this growth ETF. So it should tell you once again, at a high level, what are we looking at? Expensive shares in the growth ETF, cheaper shares in the value ETF. All right, so let's see how this performed. Oh, well, first we're gonna delve into this a little bit more. All right, so what are the top holdings? So this, of course, we're looking at the value ETF. And you can see both from a sector basis down here in the bottom, and then just looking at some of the individual names. Remember, these are all obviously US companies. You can see a lot of this is made up of financials, for example. And this compares to, well, we'll show you in a second what this compares to. But you can see what actually makes up these funds, and we'll contrast this with this growth fund, which is basically a lot of tech, consumer discretionary, and communications. So communications, stocks like Google fall into communications, and Facebook's. And once again, you can see kind of the top 10 holdings, all the usual suspects that we always talk about. Tesla, Google, both share classes, Amazon, Facebook, Microsoft, Apple. You should have heard these names over and over and over again if you've watched any of these things. And you can see obviously this growth ETF is heavily weighted towards a couple individual companies, whereas much smaller from a weight perspective in the value ETF. All right, so let's talk about what happened. Well, as I said, if we go back and look back towards the GFC and coming out of the GFC, growth has significantly outperformed. So we can see all of this in these numbers, 3-year, 5-year, 10-year. So we can see pretty significant outperformance by growth. So both outperforming the value ETF, but also outperforming the S&P 500 in general. So what should you have done if you were an investor and, of course, had a crystal ball? You should have loaded up on large cap growth because it was outperforming, despite what historically this 3-factor model told us. Now, if we look at this 1 month and this 3-month chart, you can see that things have taken a pretty dramatic turn. So you can see that over a 3-month period, there's been significant outperformance by value. And this is the first time in sort of any meaningful time period. I wouldn't really call 3-month that meaningful, but any time period that even approached 3 months, this is the first time in a very long time that we've seen this. So you can see that value is now outperforming both the S&P 500 in general and also the S&P 500 growth ETF. So the question today that well, I don't have any answers for anything, but the question we should be considering as investors is, are we at an inflection point where we are going to see a shift back or a rotation back to value? And traditionally with markets, there were smaller, shorter time periods that one or the other style outperformed, but they were not that long. They were certainly not as long as we've seen since the GFC. So there's been all these articles that have been out there. Is value dead? And yeah, we'll see. Maybe it's coming back to life. And just historically, if we go back and we look at another period with huge run-ups of tech stocks, it was, of course, the dot-com bubble. And the same, well, this is only 3 months, but what happened at the end of the dot-com bubble is value significantly outperformed. So you had all these high-flying, in retrospect, speculative stocks that weren't making any money, that investors loved, that kept going up and going up and going up. And then, of course, what happens? Well, NASDAQ goes down 75% and value significantly outperformed. So once again, the question is, are we at an inflection point where something similar may happen? Okay, let's keep going. All right, so I have this very confusing chart, especially for me because I'm colorblind, very confusing sector heat map. Now, when we talk about sectors, we should understand that different sectors have tendencies to contain a lot of a certain style of stocks. So basically, value stocks generally will fall into things that are considered more cyclical. So more cyclical means just that as the economy goes up and down, that these stocks and their fortunes, the fortunes of this company, will also go up and down. Whereas non-cyclical stocks are stocks that should perform around the same no matter what. So we use a couple examples for this. Consumer defensive is a non-cyclical stock. So think of a consumer defensive company, a company like, well, a good example is Coke or Pepsi or Colgate, Palmolive, like things that people need to buy no matter what. So if the economy's good or the economy's bad, you should still probably brush your teeth. So people are going to go out there and they're going to buy toothpaste. So that's really an example of something that that is non-cyclical, that we would expect to be slow and steady and perform okay, no matter what is happening with the economy. Conversely, there are stocks like in basic materials, for example, or what's named consumer cyclical. They have a picture of a little car there, things that you may put off buying if the economy is not doing well. So am I going to buy a new car? Am I going to let my car go a couple more years? Those are some of the decisions that people make, delaying purchases based on how the economy is doing. So traditionally, value stocks are those cyclical stocks, and that includes financial services. So what you see on this chart, so basically these numbers represent the amount of return over these different time periods. So what you'll see is things like technology have not done well in the last 3 months. Now, the fact that they're still up 6.33%, and this is the US market, by the way, it's still pretty good. Everything's doing pretty well. But what we've particularly seen is a lot of these traditional value plays have done very well, right? So even if we talk about healthcare, healthcare also is something that is non-cyclical, right? Because if you need healthcare, you need healthcare. So you should probably go get that operation no matter what's happening. So you'll see a lot of these things are not performing as well, a lot of these non-cyclical stocks, but we've seen big gains in well, look, the leader is energy. And if you remember, if you look back, after these COVID-related restrictions happened, energy was getting killed because obviously people were worried about just economic growth, and yeah, price of oil dropped a ton, but we're seeing huge increases in commodity prices and also the companies that are producing them. All right, so we got a couple questions, but we'll get into those. We'll keep going. So keep the questions coming. All right, and let's turn our attention to Australia. So, has anyone heard of these wax stocks. So these represent the tech stocks, or whatever we're considering tech stocks now in Australia. There aren't a lot of tech stocks to choose from. But you can see in the last 3 months, these wax stocks that everyone was talking so much about and that have done so well have all done terribly. So they've had really, really poor 3-month performances. I'm on this ASX stock chat board that literally lowers your IQ every single time you go on there. But I don't know, there's going to be like a Jonestown incident over Afterpay and the fact that it has not done well along with Zip. So this is just an example of the same thing is impacting the Australian market. Now the Australian market is very different from the US, basically because of the makeup of the market. So in the Australian market, a lot of the market is banks and the miners at the end of the day, so close to 50% of the market. But you've seen that sort of the Australian answer for these tech stocks, which I've listed down here, these wax stocks, done really, really poorly versus a bit of a resurgence with the banks. Now, the banks have not outperformed as much as financials in like the US, for example, because you can see VAS, so this Vanguard Australian Shares, I'm using as a proxy for the index. But still, certainly a lot better to be there than in some of these wax stocks. Oh, 2 people think that I'm funny, but I know one of them, so that doesn't count. But thank you. I don't know what that was in relation to. Okay, let's. Okay, so we've got some very good questions. All right, so we'll start with Vidanya. Is it valid to draw conclusions by looking at a very short term, like 3-month performance? No, it is not. So you should not be drawing any conclusions from this. All I am saying is that as an observer of the market, something very different has happened. So yeah, I would not. Well, I wouldn't go do anything off of anything that I'm saying. But yeah, this is a very, very short time period. But it's also, after a very, very long time period, the first change that we've seen and the first even short-term rotation we've seen back into value. So yeah, that's a good question. We've got some other good questions, but I think I'll do this slide first. All right, so at the end of 2020, there's a guy named John Reckenthaler. So John Reckenthaler works for Morningstar. Julie thinks she liked the Jonestown remark. Yes, there's nothing funnier than mass suicide. So there we go, right? Well, anyway, it's lonely in the room today because Shani's not here. She does not feel well. But yeah, anyway, let's talk about why has growth outperformed. So John Reckenthaler wrote this article at the end of 2020. If anyone wants it, email me, I can send it to you. And he wrote this article talking about this exact question: why has growth outperformed? And I'm going to talk a little bit about has anything changed. All right, so he gave 4 different reasons to potentially explain why growth would outperform. Now remember, this was before, so this, I believe, is either early 2021 or the end of 2020. This is before this little potential rotation, well, short-term rotation that we've seen. So he went back and he looked at some of these results. So number 1, their recent business results have been stronger. All right, so it is hard to obviously track this. So what he did is he went back and he looked at the time period between 2015 and 2020, the end of 2020, let's say. And so he went back and he looked at, used Morningstar indexes. So this is once again looking at the US market, but he was looking at Morningstar Large Growth Index. So it had an average price to earnings in 2015 of 24.2 times. Then when he was looking at it at the end of 2020, he found out that they carry a price to earnings multiple of 45.10. So what does that mean? So that means that over that 5-year period, investors, large cap growth investors, were willing to pay 87% more for earnings than they were in 2015. So pretty interesting. He also looked at the price appreciation in that same time period, and it went up 161%. So that Morningstar growth, large growth index went up 161%. So what we can do then is we can basically figure out how much earnings grew. Because if we're willing to pay a larger multiple, we can compare that increase in multiple with the increase in return. So hopefully people are following that. So what that means is that over that 5-year period, large cap growth companies in this Morningstar index grew their earnings by 40%. All right, so we understand that they're growing their earnings. They're also, investors are willing to pay a higher multiple for those same earnings. So there we go. All right, so then what he looked at, and he of course was thinking about this Fama and French study that we talked about in the beginning, is then he went back and he looked at the Morningstar Small Value Index. All right, so he did the same exercise. Now, over that same time period, from 2015 to 2020, the price to earnings ratio reduced. So people are willing to pay 15.6 times in 2015 and 14.6 times at the end of 2020. And the price of the index increased by 23%. So you can see the outperformance there, right? 161% versus 23%. So what that means is that small cap companies managed to grow their earnings by 31%. So we'll have to trust John with all the math here. But if we take a step back and we look at this first thing, the recent business results have been stronger, not that much stronger, right, at the end of the day. So they grew their earnings by 40% versus 31%. And that's supposed to justify this outperformance of 161% versus 23%? Well, no. So the answer to that first question is no. The recent business results have not been that stronger. They've been marginally stronger. So over 5 years, they grew 9% more. That's something, but at the same time, it's not something that necessarily justifies that price, in my mind. So, okay, that's one question. The second question is, or the second explanation could be their future outlooks have become brighter. Okay, so if we sit there and look at that, not really. At the same time, he looked at forward P's as well, and they really haven't. So there hasn't been a giant increase in what growth stocks, the expected growth they were supposed to have in 2015 versus 2020. So not really that one. Then he looked at number 3, they benefited more from declining interest rates. Okay, yes, they did, and let's talk about this, and we'll talk about sort of what potentially is happening in the market based on this for a second. So what are you doing when what are you doing when you're valuing a company? You are projecting future cash flows out, and then you're discounting them back to the future day. One of the things that goes into that discount rate, of course, is a level of interest rate. Now, if you're a growth company and more of your earnings are further out into the future, then yes, you do benefit from declining interest rates. So that is an important one right there. The question I would have for everyone right now is, do we think interest rates are going to go lower? Even if they stay the same, do we actually think they're going to go lower from this point? So is this going to be any sort of future benefit for these companies? Now, we'll get into this in a second, and this has anything changed, but that's a question for investors. Finally, his last point is, have they become investor darlings? Yes, right? So this is the driver. Once again, when we go back and we look at those multiples investors are willing to pay, that is the driver of where these returns have come from. That investors are willing to pay 45 times earnings versus 24 times earnings. So that, of course, is the benefit. I think John is saying, and he finished his article, I think an interesting place, it's difficult to escape the conclusion that this trend has at least temporarily run its course. I will be surprised indeed if large growth stocks once again outperform in 2021. So obviously he's looking pretty smart right now, but we'll get back to John. Okay, let me go through, has anything changed? So let's talk about what's happening. And we're actually recording a podcast right after this to talk about what's happened in the past week or so in markets. Once again, not because we want to use short-term movements to make any giant conclusions, but just because we want to explain what's happening with markets in terms of inflation. All right, so what is basically happening at the end of the day is that this third point right here is the market started to get a little bit spooked about future interest rate levels. So central banks, of course, have come out and said that interest rates are going to stay at a very low level for an extended period of time. With the uptick we saw in inflation in April in the US, I think the market became a little spooked that maybe this isn't going to happen. And this, once again, is looking at investor expectations versus changing investor expectations. But once again, as an investor, I think the important thing to remember is even if central banks are completely right, so the market's worried now that central banks may not be able to keep interest rates as low as they are for the next 3 years or so, even if they are right, we're not going to get any benefit from falling interest rates again, right? It's very unlikely, because they'd have to go negative, which is possible. But I think as investors, we need to understand that this conclusion may not occur. So what has happened, and the market got a little freaked out about this in February as well. So what has happened is a lot of these, if we go back to this Australian example, a lot of these growth stocks have been slammed because people are, of course, nervous that this whole interest rate scenario may not play out and that rising interest rates would hurt growth firms just like it benefited them as they were going down. I'm going the wrong way. Okay, so we've got some questions. Let's go through some questions and we can get back to this. All right. Okay, so we'll start with Lisa of Alpaca fame. So Lisa's saying, is growth a truly sustainable goal given the limitations of our global primary assets and the pressures of overpopulation? Is this why value is becoming a positive feature of global markets? Okay, so I think we're so two different things, Lisa. So growth and value does not necessarily equate at all with sustainability and the sustainability of the underlying business model. So many of the growth companies actually have less of an impact on the planet than many of the value companies. And we can do this just by looking at industries, right? So if you're a coal miner, you're most likely a value stock. If you are a tech company that has a small footprint relative to your revenue and your sales from both a employee and just sort of carbon perspective, then you're probably a growth stock. So remember, companies can grow. And one of the reasons people like tech stocks so much, why they're such great companies, is because they're really, really scalable, which means they can grow really, really quickly without getting a bunch of new employees, building a bunch of new buildings, building a new factory, all the stuff that traditionally companies had to do. So I do think, I do think potentially it's more around the interest rates than just kind of a sustainability standpoint. Oh, this is a really good question. Okay, we've got another question from Vidania. I hope I'm pronouncing your name correctly. Could the S&P 500 numbers also mean that we may be at an inflection point to switch from passive to active investing? Okay, that is a really, really good question. Okay, so let's talk a little bit about passive investing. And we did a podcast on this a couple podcasts ago, and we talked about passive investing. Okay, so passive investing has become really, really popular once again since the GFC. So if we go and we look at U.S. numbers, I'm sure they're similar here. Something like went from 25% of the money in the market was passively managed to like 50%. So don't quote me on the exact numbers, but it was a very, very large gain, and it's approaching 50%. Now, if we think about passive investing, most money that goes into passive investing is going into a market capitalization weighted index. What that means is more of the index is made up of larger stocks. What that means is that when large cap stocks do well, that just sort of compounds, right? So at the end of the day with passive investing. So if just to use an example, if there are two stocks that make up an index, and one stock starts doing really well, it's going to make up more and more of that index. So what that means is when passive money comes into the market, comes into that index, more of it goes to that large stock, which means it just gets bigger and bigger and bigger and bigger. And that's what we've seen. So if you look at these giant companies, and I don't have the stats in front of me, but if you go and look at some of these giant companies, if you look at Apple, for example. So Apple's the biggest company right now in the US market. And Apple has grown just off the charts in terms of market capitalization because money is just getting shoveled into these passive indexes and more of it is going to Apple. So passive investing in a way, and passive investing has probably contributed significantly to the outperformance of the same companies, the fact that we have not seen any sort of rotation. The problem with this is, as a passive investor, is that when the market turns around and those companies that have been doing really, really well don't do well, you are going to not do well as a passive investor. So that's the problem the situation we may be at is that what that does is, of course, is that is going to start compounding those losses because as these large companies do poorly, they're going to drag the whole index down, meaning index investors are not going to do well, which means they could potentially panic and sell, which once again drags that index down, drags down disproportionately those largest companies. And that's something that we sort of saw without this much passive money in the market. We saw this a little bit after the dot-com bubble burst, where you have these falls in these bigger companies. So what a active manager will always tell you is they'll be able to navigate all of these different market conditions. Now, in reality, they haven't done a good job at it, certainly in relation to their fees, but that is one of the theories, of course, that active investing is, if we are at an inflection point for the market in general, active investing, the managers have more flexibility to actually consider things like this and make adjustments. That was a good question. Someone else liked the Jonestown comment. Yeah, who knows? Okay, here's a really good question. Here's a good question for Michael. So we are recording a podcast on this very topic on Thursday, Will, that we'll publish on Sunday. See, Will sort of got screwed now that he went on vacation and comes back and there's all these demands. But anyway, so Michael asks, why have many growth stocks dropped after reporting superb results? Many tech companies have suffered what appears on the surface to be unfair downgrades. Okay, so we're going to talk a little bit about, and this is what the podcast is about. It's about sort of priced into the market and expectations. So when I first started investing, I always had this same problem, is that I buy a company and then I get all excited and the results came out and I read them and I was like, wow, this is really, really good. You'd see enormous increases in revenue growth and everything else. And I thought, wow, this is awesome. And then I go look and the stock price was down. And the reason that is because everything is based on investor expectations. So at the end of the day, how something's going to perform is based on how reality compares to those expectations. So, an example, and well, I'll use a real example in a second, but yeah, a simple example of this is that if somebody thinks a company is going to grow 100% and they grow 95%, that's really bad. Now, on the surface, growing 95% is great, but remember what's priced into that, what the expectations are, is 100% growth. And that's why you're always going to pay more for growth stocks. You're going to pay more for that future growth. But the question is, can that growth live up to what your expectations are? And a good example of this that we're going to cover in this podcast is we looked at Tesla. And, Tesla, God, what was it up last year? Something like 700%. Once again, don't quote me on that exact number, but something insane. And because it's a great story, right? It's an electric car. They've got this cool technology. We're trying to move away from fossil fuels. Like it all makes a lot of sense. The problem is, what is the price that you are paying for that growth? And I'll look it up on here, so I'm not just making numbers up. All right, so let's look. I'll share my screen Sorry, this will be an extended answer, including me going to a website. All right, so we're looking at Tesla. So if I go and look at a quote for Tesla, Tesla has done very poorly lately, but very well last year. All right, so if I do 1 year, and it's been down a lot, still up 262%. If I go back to January 1st, and I go to, we'll just do January 1st, 2021. Okay, whatever, it's giving me the same thing. Yeah, 720%. So it went up 720% last year, 2020. Not so good this year, but only down 16%. But anyway, if I go and look at the valuation of Tesla. All right, so what are we looking at? Current. So current price earnings, 571. And even the forward price earnings is 129. Like that's really, really expensive. So what I would say is Tesla just reported a great quarter, for example, and the share price dropped. And one of the reasons is it's what are these expectations that are baked into a stock that's selling at 571 times earnings. So the other example I'll quickly use, Michael, is Philip Morris. So there was this book written by Jeremy Siegel. I talked about this in this Equity Mates panel I did a couple weeks ago, where the beef was started, right? Well, our producer Will, well, videographer right now, but producer of the podcast, wants us to get in this little war with the Equity Mates. I actually think they're nice guys, but anyway, that's Will's dream. So I did this panel, and the example I was using, and we were talking about alcohol stocks, but people are worried about that globally drinking is going down. Not in my household, but somewhere else, I guess. And there's this guy, Jeremy Siegel, who's a professor at Wharton, University of Pennsylvania, and he wrote a book, Stocks for the Long Run. I believe that was the one that it was in. And he looked at the S&P 500. He went back to 1925. And he looked at 1925, I think, to 2003, and looked for the best performing stock, and it was Philip Morris. And it was Philip Morris, and they're a global, they've broken up into a couple different things now, but they are a global cigarette producer. And, they did insanely well. I think over that time period, if you invested $1,000 in 1925, you'd have $380 million. And it's crazy. And so it was the best performing stock, like 17% a year, but it was in a declining industry. So cigarette smoking, at least in the US, peaked in 1961 and has fallen significantly since then. There were lawsuits, there have been changes to marketing, there are product warning labels that are all over cigarettes now. And even though all of this happened, it was the best performing stock. Why? Because there are really low expectations. And the difference ultimately in the long term is what are the difference between the expectations of the market, which is priced into a stock, and how it actually performs. So that's my very long way of saying, Michael, we have to be careful. What are people thinking when they're buying these stocks? What do they think is going to happen? And that's both sophisticated investors who have built out whole models and unsophisticated investors who just think it's going to go up. And when that expectation is not met, they're going to sell, and that's going to pull the thing down. All right. Okay, so we've got a good question saying, what should be an ideal P ratio to have confidence in the performance of a share? Okay, that's a really, really difficult question to ask. Well, it's an impossible question to answer, but I'll do my best in trying to skirt around it. So remember that P ratios, and people use P ratios from a valuation perspective because they're easy to use, but the P ratio in itself has no answers for you. It has no answers because you need to look at holistically what the company is doing. So number one, a P ratio, they're backward looking. There are some forward Ps, but they're only 1 year, and we want to invest way into the future, right? So they're backward looking. And what that means is that if I take two companies and one's trading at a P level of 20 and one's at 10, I can't say one is good or bad. And I can't pick a level that would indicate a good PE or a bad PE. And the reason for that is things like growth. How much do we expect the company to grow? What are the profit margins of the company, right? So all of these things are really, really important. So you have to understand the company to put it within context. Now, you can use P's as a relative valuation technique, and that's what they are. By comparing them to something else, you can compare them to another company, and then in your head try to figure out, is it justified, right? So if I go and look at Volkswagen, who sells 10 million cars a year, and I look at Tesla, who just sold 800,000, or we think will sell 800,000 cars next year, I can go look at those PE ratios and think like, okay, is it justified, the expected growth we see in Tesla, given how much smaller they are than Volkswagen, is it justified to be trading at 571 times earnings versus whatever Volkswagen is? So that's the question. And so you can compare things. You can compare things to historic time periods, like what John Reckenthaler was doing when he says large growth stocks were trading at 24 times earnings 5 years ago, and then they were at 45 times earnings. Is that justified? Has anything happened during that time period to justify that? That's how we can use PE ratio. So I would use them as a tool to sort of start thinking, like doing some critical thinking about where things are. But yeah, sorry if that wasn't the best answer, but that's all I got. Okay, so good question from Randall. Does being an investor darling, I've never been anyone's darling, let alone investor darling. Does being an investor darling explain anything? Is it a rational herd mentality, or is it unexplained insight into the market that we are none the wiser about? Yeah, it's a good question. Unfortunately, Randall, we will not know that until we see what happens. So unfortunately, you don't really know if there's a bubble until the bubble breaks, right? Like the whole point of the bubble bursting is what actually shows you that it's a bubble. My personal opinion is I'm more on the irrational herd mentality side of things, but once again, we don't know who will be right until after it's happened. One of the things that's happened, of course, for a very long time, really, if we look back to the mid-'80s, is we have seen this sort of steady drop in interest rates. And there's been blips up and down, or blips up, but it has been steadily down. And the question we're all confronted by as investors is, do interest rate levels as they currently are justify what is one of the most expensive markets in history? And that's what we're trying to figure out. And once again, there's no real right answer to that. What I will say is, as investors, we need to look at what's going to happen from today into the future. So the question, and that goes back to one of the things on the slide, the question is, we've had this huge benefit from falling interest rates, which has expanded the multiple of stocks, particularly around growth stocks. Do we think this is going to happen again? And it's hard to say it's going to happen again when interest rates are close to zero. But that, once again, is a personal opinion. All right. Look at this, Will. We're out of questions, and we're 15 minutes early. Well, that's good news. Oh, we got another question, just as we said that. Every time I say we're out of questions, we get more questions. It's exciting. Okay, so we've got a question from George saying, are US, EU, and AU markets overpriced these days based on the average PE ratios? In the past, if yes, is printing of money going to reprice what we know about the average PEs? Say from now on, would we be trading more like an acceptable PE 20 instead of 16? Okay, so really good question, George. Valuations have risen over time. So if we go back and we look at Benjamin Graham's days, after the stock market crash in 29, he was buying stuff at valuation levels that I can't guarantee anything, but it's very unlikely we'll ever see again. So we have seen a steady uptick in price earnings ratios over time. And this makes sense, right? Makes sense in a lot of different ways. Number one, there are more investors, there's more money in the market. Interest rates are lower. As you were saying, central banks have gone beyond just interest rates and are sort of flooding the market with money right now. So yeah, I mean, I think having a price earnings ratio that's higher than it historically has makes sense. I just don't know about the degree to which we have a price earnings ratio. So what I would say is one thing you can do, and obviously I work at Morningstar. But one thing you can do is, I'm going to go back to the website. You can look at what our analysts think. Now, our analysts do not think that the market is as overvalued as a price to earnings ratio would indicate. They do still think it's overvalued. Now, the difference is, why am I not scrolling? All right, so the difference is that our analysts, of course, are looking at a bottom-up analysis of every company in their coverage universe. So if we look at Australia right here, their price to fair value, so the fair value is what they calculate, there's a definition, is what they calculate that the fair value of a company is worth. So they see Australia is 9% overvalued. So that's what that 1.09 indicates. Now, this time last year, remember, we're still recovering from that COVID market dip. They saw it at 11% undervalued. See the Kiwis, I think it's 12%. And yeah, you can go through and look at all the different markets. Now, couple things I would consider with their price to fair value is a price to fair value of 1 does not necessarily mean we think you should buy the stock. We think you should have a pretty significant margin of safety involved. But that's another way to look at valuation levels. Certainly, the valuation levels that our analysts think their coverage universe is. And remember, a lot of stuff is outside of their coverage universe. A lot of the very speculative, small cap stuff that we've seen go up and up and up. A lot of that's outside of their coverage universe, but yeah, that's what they see the overall market at. And remember, this is equal weighted. So that's the other thing I'd say. This is an equal weighted look. So what that means is, whereas Apple might make up 7% of the 7% of the S&P 500, if we were looking at 500 stocks in the U.S., it would only equal, I can't do the math in my head, but 1 divided by 500. So it would be equal weighted. So that's the other thing, that if we do see run-ups in valuation levels of large cap growth stocks, for example, of the larger stocks, then that wouldn't be captured in this. Okay. Okay, so we've got a question from Patty. Patty's saying, would a small cap value index fund be considered a hedge against this historically high market? Yeah, I mean, it depends. It depends what happens, obviously. So I would not call it a hedge. So a pure hedge would mean that if the market goes down, it would go up. So a pure hedge would be one of these bear market ETFs that there are. So there are ETFs out there where basically they do the opposite of the market. So the market goes down 10%, they go up 10%. And then there are some that actually have leverage involved. So the market goes down 10%, they go up 20%. Now those are very, very risky investments. And anytime you're basically shorting the market, I mean, at the end of the day. And you just have to be very careful with that, because once again, a stock can go up as many thousands and thousands and thousands of percent as possible, well, it can go up in infinity. You can only go down 100%. So be very careful about those. So yeah, I'd be careful about considering a small cap value index fund a hedge. Now, Fama and French would argue that based on historical numbers, small cap value will outperform over the very long term. Now, there are a lot of people that sit there and say that's not true anymore, and things have changed. So once again, it's easy to go back and look at historical numbers and draw conclusions about it. It's much harder to sit there and look into the future and think those conclusions will actually come true. So that's just what I'd be very careful about. Okay, will a growth stock become, here's a good question from the anonymous attendee, will a growth stock become a value stock and vice versa? How so, and how would we know it has changed? Okay, so what would have to happen? So if we think about this, if we have, well, once again, we'll use a simple example. We have 2 shares once again, we're going back to this index that has 2 shares in it. You have 1 share that is trading for 20 times earnings, and you have 1 that's trading for 10 times earnings. And this can be any one of those multiples: price to book, price to earnings, price to cash flow, price to sales, any of this stuff. So you've got 1 that's more expensive, 1 that's less expensive. We would put 1 in the value index and 1 in the growth index. All right. So what would have to happen for them to switch? Well, basically, the value stock would have to become more expensive than the growth stock. And that can happen in any way, right? It could happen if the earnings fell significantly. It could happen if the price fell significantly of the growth stock, or vice versa. The value stock could gain a lot and be more expensive. So there's lots of ways that that can happen. So yes, you can switch, and you can have these rotations between the two of them. Now, in many ways, it's unlikely. It's unlikely that you are ever going to pay more for a oil stock than a technology stock. And the reason is because of some of the things that are intrinsically built into those industries. So we'll use those 2 simple examples. An oil stock. So if I'm ExxonMobil, I have a very, very capital intensive industry, right? So what do I have to do? I have to go over to some very remote area of the world. I have to find oil. I have to build a plant, or I have to drill for oil. I have to get it out. I have to put it on a ship. I have to bring it back. I have to put it in a refinery. Then I have to put it in a pipeline. Then I put it on a truck. Then the truck delivers it to a gas station. It's actually amazing, or petrol station, sorry. It's amazing that oil is as cheap as it is. So I have to do all of that. I have to build all of that. There's all these costs associated with it. If I'm a tech company, once again, I'm being very simplistic here, I find a couple smart people, I buy them a laptop, we sit in a garage, and we create a company. So when we've talked about tech companies before, they are scalable. They do not require a lot of capital to build or run. There's a lot of reasons why that business model is a lot better. And there's a lot of reasons why investors would be willing to pay higher multiples for that earnings. Now, that doesn't mean that it's a good investment necessarily, but it does mean it's going to be very difficult for tech stocks in general to become value stocks, given all the natural advantages that you have of a company that is so scalable and so capital light. So you can see rotation between the two, but there's a lot of reasons, sort of traditionally with the industries, why that's probably not going to happen. Okay, good question from Chris. So he says, how much influence do economic announcements from the RBA, the Fed, et cetera, have on value and or growth stocks? This is also based on investor expectation. Yeah, so it is. So if we talked about, and this is what we'll do, we'll record right after this. If Shani gets off her deathbed and comes to work, we will record a webinar just talking about what's happened with inflation. So basically, what has happened recently is as the market has started to worry about inflation and subsequently started to worry about interest rates, they have punished growth stocks for that. And they punish them for one reason, because they are their valuation is very based on earnings out into the future, which means that that discount rate really, really matters. So in a rising interest rate environment, a lot of people are worried about how growth stocks will perform. So I would say yes. So far, economic announcements have just backed up what the central banks have been saying. They say they are still willing to let inflation tick up a little bit. So if you're looking at their 2 mandates, it is stability of the currency, so that's basically inflation, and then it's looking at the economic prosperity and unemployment rate and trying to get the unemployment rate as low as possible. Central banks around the world have said that they are primarily looking at that unemployment rate and the economic prosperity of the country that they're associated with, and that's their bias, and that they'll let inflation tick up. What the market's worried about is they'll somehow come out there and say that it's going to change. So if a central banker comes out and says that, and comes out and indicates that that is actually going to change, I think look out below in terms of where the market's going to go. So the investor expectations are still that we're going to see years and years of interest rates that are at the same level. If that is forced to change, and that's why people are worried about this uptick in inflation, then we could see very, very different market outcomes. So yeah, I think that's a question where we're looking at expectations. All right, I think we're going to stop this now. So Shani's alive and is back to record the podcast. So we'll do that. We'll put that out tonight in case anyone's interested in investing Compass, and we'll talk about inflation and what's happening. But anyway, thank you guys for joining. I'm trying to remember what we're doing on Thursday. Hold on, I will very quickly do this. I should really remember what's happening for the rest of the week sometimes. Maybe not. That thing isn't working. Oh, here we go. We're going to talk about, no, I don't say that. Anyway, we'll be back on Thursday talking about something. You've seen the schedule. Did you just walk in while this thing was happening?
I'm so sorry. I thought it had ended.
Okay, you could have at least said hi. Well, anyway, that's Shani. Thank you guys for joining. And if you do have any questions, you can email me, mark.lamonica1@morningstar.com. And Rodney's saying how to select funds and ETFs. So that's what we'll do on Thursday. So Rodney knows what's happening. I do not. And thank you for your comment on the Facebook board, Rodney, on the Equity Mates board. Anyway, I will talk to you all later.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.